right. So thank you so much for being here. I really appreciate it. I actually get asked to talk lots of times all over the world lately. I've been this year alone. I've been in three different countries talking, and but I live in Chattanooga. Technically, most people think I live in Puerto Rico. So if you follow me, you might assume I live in Puerto Rico. Most people assume that's for tax advantages. If you don't know about that, I'm happy to talk to you about that at some point. But I don't need that because I'm a multifamily investor, and multifamily is highly tax favored. Although those tax advantages for multifamily are sort of fading out, and if you guys want to ask about that at the end, happy to talk about how that works. But I do technically live here. I spend about 40% of my time in Chattanooga, so it's really exciting for me when I can come back and talk in Chattanooga. And I actually have this event plus two other events in the next 3 weeks. So I'm here for a few weeks. So if you guys want to hang out or get to know me better, just let me know and we can maybe make that happen. Anyway, so as he said, I'm about 5, 6 years ago now. My partner Brian and I started the Old Fashioned Real Estate Show. On the Old Fashioned Real Estate Show, we literally drink old fashions like the bourbon drink and talk about real estate investing. It's pretty fun to watch on YouTube. We actually don't put that many episodes out. I mean, almost never have guests. So it's really just like when we have a topic we want to talk about, we just go ahead and talk about that. Let's see here. Of course, it was working when we tested it a second ago. So, all right, very good. So I just need to point like right there. All right, so you told me a little bit about my background, so I won't spend a lot of time on that. That's actually a 41 unit building that I own up in Detroit. So I have multifamily real estate here in the Chattanooga area. I have a little bit about in Albertville, Alabama. We have 56 units there, about 200 units or so in the Chattanooga metro area, including North Georgia, Fort Oglethorpe, Ringgold, stuff like that. And then I have about 150 units in Detroit. So I don't really know. I always say 350, but it's actually more like 370 or something like that. So I want to talk to you just a little bit about my background. If I can, am I pushing the wrong button?
See, that button right there.
Wait, this one right here. So I am pushing the wrong button. Show me again. Oh, that okay. All right. So I don't know if you guys know. I don't want to spend a ton of time talking about my background because I want to really get into the meat and bones of real estate investing and what I think multifamily is really where it's at in today's market and why I think that and how you can analyze that because that's what he asked me to do. But I think it's worth telling a few of you a little bit about my background. I think a lot of people have already heard this story, but there are people here I don't know, so I'll share it. Does anyone who doesn't know me have an idea what this particular photo is? Anyone doesn't know me? So I'll just cut to the chase. That's actually a biopsy needle. So they drill into your hip with that. In September of 2008, I was a bankruptcy attorney in West Michigan, and I was diagnosed with leukemia. And that ended up causing me to go bankrupt in December of 2010. So I went from bankrupt in December of 2010 to fully retired in 2016. So bankrupt to retired at 6 years. I quit my corporate job and I was going to just live off of my rentals. I was a single family real estate guy. I bought real estate in Detroit. I lived down here. I actually moved to Chattanooga to take a job in Tunnel Hill, Georgia, if you can imagine that. So that was pretty fun. So I was working in Tunnel Hill. The company I was working for was actually getting sold to US Express at the time. I helped negotiate that sale. I got 6 months severance and I said, I got to get out of here. Like, I'm just going to chill. I'm going to go to the beach. I'm going to hang out. I'm going to travel the world. And I'm going to live on my 57 free and clear houses that I had in the southeast side of Michigan. And so I am very familiar with where most of you all are. Like, most of you are buying single family real estates. If you're not, you probably should. It's a little bit hard now, as you probably know, but it's a really lucrative way to live. But what happened between March of 2016 and let's say May of 2016 is I got bored out of my mind, right? Like you can't, it turns out at 39, it's cool to be able to say you're retired, but you get bored really fast. So I spent like 2 weeks at a condo that my dad owns in Florida, sitting by the pool talking to all these old people, and they'd be like, "Oh, you're on vacations visiting your dad." I'm like, "No, I retired." And they would just be like, "You can't have retired. That's dumb. You can't retire." Like, there's this resistance to that. And I think at the time I was like, "No, I'm retired. I'm never working again." And I haven't ever taken a corporate job since then. So in a way, it was true. But the reality is, um, real estate investing isn't about retiring early. It may seem that way to you. It's not about if you're just doing it for cash flow or you're just doing it for equity, you're probably not going to enjoy it. Like you need to find something that you enjoy. I love real estate. That's why I invest in real estate still. I try to do more interesting projects now. So what happened was I started thinking like I'm going to like listen to real estate podcasts and figure out what else I can do. And I'm going to start my own podcast. And I'm going to try to educate people about real estate and how great it's been for me. And so that's what we did back then. We just started doing that kind of stuff. And I remember I was listening to, I don't know, I started at episode 1 of the Bigger Pockets podcast, and I was on like episode 50 something. And I heard this guy, Brian Murray, talk about his book, which was Crushing It in Apartments and Commercial Real Estate. Great book. Like, honestly, if you just want to leave now and go read that book, you'll probably learn what you need to know. Like, but you're here, so you might as well stick around. So anyway, the real question is, how did I get from bankruptcy to this room? And that's what I'm talking about. It's like I did it through positive mindset, right? And real estate investing. I can talk about positive mindset. I have a whole talk that I love to give on motivation, mindset, living the best version of your life. And that's what my podcast, Last Life Ever, is about. And actually, if you want to hear that talk, I'm giving it on August 1st at the Southeast Best Real Estate Meetup. So we'll just put that pin on that and we'll talk about real estate investing today. Or you can also read my book, No Bad Days. It was the Amazon bestseller for about 4 hours. So that made me happy. I'm a best-selling author for the rest of my life. I appreciate it if you bought it. If you haven't read my book, though, you could buy it today on Amazon for like $16. You could bring it on August 1st and I'll sign it for you for free. How's that, right? All right, so this is what I want to talk about today. Cap rates, real estate market cycle, and risk mitigation. Of course, I want to do it in the real estate market cycle first. So I want to be a little bit, I want to be a little bit interactive if it's okay with you guys. I think it's more fun if we have some back and forth. So if there is a question or you don't understand something that I'm saying, please just stop me and ask. But if it's something that's not about what we're talking about right at that second, then let's wait till the end and I'll make sure we have 10 minutes or so for additional questions at the end. So that I want to talk about the real estate market cycle. So first off, I actually advanced this a little bit earlier than I meant, but most people think that the real estate market cycle is 10 years, 12 years. Does anyone have an opinion on that without reading my chart that tells you the answer? Anyone heard different? All right. Well, the true answer is if you look at this chart, you can see that it is essentially an 18-year. It doesn't always hit 18 years, but you see the early ones, right? 1836 to 1854, 1854 to 1872, 1872 to 1890. It was very much an 18-year cycle, and it remained that way even on average, other than during World War II when they skipped a couple of cycles. It remained there the whole time until the government, the Federal Reserve, started manipulating the real estate market cycle. That's the reality of it. The guy who came up with this chart is named Fred Foldvary. He wrote this chart, and he came up with this chart, and he wrote the book, The Depression of 2008. Does anyone remember investing in 2008? Is anyone in that market? What I love about Fred Foldvary is that he wrote this book, The Depression of 2008, in I forget exactly when he wrote it, around 1999. So sometime 10 or 12 years before the actual Great Recession, he wrote a book called the Great Recession or the Depression of 2008. He then later followed up with the Depression of 2026. So this is our starting point, right? Fred Foldvary, who was able to predict the greatest real estate crash in our lifetime and predict it 10 years ahead of time, in 2012 told us that in 2026, the real estate market is going to crash. So let's start with that piece of information. And you can read every article he ever wrote. Just Google him. You can find it. There's a website. I forget the name of it right now, but every single thing he ever wrote is on that website. He's an economist, classically trained, super smart guy. But he's also a cycle guy, and he analyzes how the cycles work. And I love this quote, right? Almost all economists, journalists, analysts, pundits, bloggers scoff off my predictions because the cycle exists because people don't believe in it. So the basic super short version of the cycle is that, well, let me actually show you what the cycle looks like. This is what the market cycle looks like. Has anyone ever seen this chart before? If you haven't seen this chart, take a picture of it, find it online. The source that I use is a real estate finance textbook from 1996. It's, I think, one of the first places it ever appeared. The guy who wrote it was Mueller. I can't remember his first name right now because I didn't put it on my slide. But this market cycle chart will tell you exactly where you are in the real estate market cycle, no matter what, if you understand it correctly. So you have the horizontal line, right? The horizontal line is a long-term average occupancy line. So you got this horizontal line. If we're above long-term average occupancy, we're either in phase 2 or phase 3. We know that for sure. So if you can go find the data, it's available. I don't know what, depends on your market, depends on what you buy. If you're buying single family houses, average occupancy is different than if you're buying multifamily or office or industrial. But the data is out there, right? So you can figure that out. And you can do this by, if you have a nice size portfolio, you can do it with your own portfolio. Hey, I normally am 95% occupied. Now I'm 93% occupied. But the best thing to do is look at these really long-term trends, like 50-year trends. What's the average occupancy of apartment buildings in Chattanooga, Tennessee over the last 50 years? Because if you look at like last year to this year, that's direction, which is the other line, right? The vertical line is occupancy rising or is it falling? And those are the only two variables you actually need to know. Is occupancy rising or is occupancy falling? So I'm going to take a little survey here. How many people in the room are investing in real estate right now? How many people do multifamily real estate right now? Okay. And when I say multifamily, I'm actually not talking about duplexes, triplexes, and quads. I'm talking classical commercial multifamily. Do you guys know the difference? 5 units and up. Anyone doing 5 units and up? Okay, so we have a few of you. So people that are doing 5 units and up, do you feel like your occupancy is going up or down right now? Down? No, up. Okay. So on average, and I mean, I have a lot of units in the area, our occupancy is pretty strong. It's actually been pretty stable, but we've been really working to mitigate it. But if you look at the data, or if you just ask, Brandon, we'll know the answer. What's the answer, Brandon?
We're actually going down. Prices are softening.
Exactly. So the data shows that occupancy is falling. So if occupancy is falling, we know we're on this side of the curve, right? Like we're between 11 and 0.1. So we're either in hypersupply or recession when it comes to multifamily. And I want to explain why this matters. So what happens is, you see one is at the very bottom of the recession. It's also the first point in the recovery. It just goes up and back down, right? Up and back down. And, hopefully it trends up overall, but it's just a curve. It goes like this. And what happens, and this is where Fred Foldvary came up with his prediction actually, is that once you get, actually, let me ask one other question. I think this might be useful. At what point on this chart do rents start falling? Anyone want to take a guess?
11.
11?
14.
14 is the right answer. Good job. So 14 is the point where long-term historical occupancy, where you cross that line and you still have more supply coming online than you have, units being absorbed. So your absorption is still going down. You're having more and more supply come online. But now rents are going to start falling because if you're a multifamily operator and you say you built a new building and you're like, hey, I need 95% occupancy. That's the long-term historical average. So that's about right in Chattanooga, about 95, 96%. And my rents are only giving me 94% occupancy. You're going to start lowering your rents to get up to the occupancy level that you need to have your projected returns. And that does not happen until you get to the point where occupancy is below that level. That before that, in hypersupply from 0.11, 12, 13, even 13.99, it doesn't matter. At all of those points, occupancy is still high, right? So if you're a new multifamily occupancy, even though occupancy is falling, if it went from 97 to 96 and you need 95, you're not lowering your rents because you're still above your original projections. So that's why it becomes really important to understand that. And now you said rents are starting to soften too.
Yeah.
So that means we're probably right around 0.14, which means if you're thinking about building multifamily today, you should not be building multifamily. It's not a good idea. Like it just isn't, because your projections will be wrong. Rents are going to fall. Now, that's in line with what Fred Foldvary says, right? Because if we're there, like we should be, getting ready to go into recession. Now we're a little bit early for a 2026 recession, and I started thinking about that a lot. But before I tell you about what my thoughts on that are, I'm wondering, Does anyone have any questions about this chart? Does this chart make sense to you? We understand that like the very best place to buy is probably like 0.16 or 0.1, right? That's like buying in 2010, 2011. Everything's going to go up forever. We feel good. We feel really smart. That's when I started buying in Detroit. It was a great time. Everything we bought in Detroit doubled and then tripled and then quadrupled and then, 10 times. I mean, I'm literally saying 10 times. Some of them went up 100 times. That's insane, right? And you're thinking, like, how can that possibly be? Well, we were buying houses for $500. So 100 times was, $50,000. Maybe 200 times. Some of those houses that we bought for $1,000 or less are worth 100 grand. That's insane. But the reason is because in Detroit, we were way, 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 way back in the recovery, the beginning of the recovery at that time, and they were artificially taking inventory off the market. The city went bankrupt. They leveled huge amounts of inventory, even though the population was declined. And then the population started to rebound, and then, man, occupancy shot up like crazy, and that's when you make all your money as a real estate investor. You have to be able to survive the recessions. And we've been in hyper supply for a long time. In fact, to be honest with you, I assume we would have had a minor recession sooner if it wasn't for all of the government injection of capital. And by the way, remember this chart that we were on before, with it gets really messy once the government gets involved. The Fed starts throwing. So this doesn't prove we're going to have a recession tomorrow, right? We could move from 0.14 and they could throw a whole bunch of money at everyone, and all of a sudden we could be back at 0.12. That's what happened with COVID. We were like 12 or 13 in most markets nationwide, and it got pushed back to about 10, right, when COVID happened. And the reason this is an 18-year cycle, by the way, is you're making a decision to buy. The builders don't stop building until rents fall, right? So they build right up to 0.14. Well, when you start building at 0.14, you've got 2-3 years from groundbreaking to when it comes out. That's new supply coming on, even though occupancy is low. Because once you start building, you have to keep building. You can't stop. You lose even more if you stop. So occupancy continues to decline. It continues to decline until the rents have fallen sufficiently that no one's building new stuff. And then 2 or 3 years goes by, and all that new supply gets absorbed. And then rents occupancy starts trending up. And when occupancy starts trending up, people still aren't building, right? They can't build because rents are still falling. They're still below occupancy. They don't start going up again until you get to 0.6. At that point, we're in a recovery, we're in an expansion period, and everything's gravy for 6 to 10 years, right? That's how it gets to be 18 years, though, because of the lag in the construction cycle. And if people believe this stuff, and they're starting to, it will mess with and flatten out that curve. And that's what we're seeing. So we can't believe exactly the 18-year real estate market cycle anymore, but you get the general idea.
What causes? What are you looking for whenever you see the one? Like, what tells you that the one is here?
It's easier to see retrospectively, but it's technically the point where occupancy starts going back up, where you're no longer having more supply come on the market than new demand.
It's going to be not just the whole market; it'll be subsections of the market.
Super localized, right? Office buildings in Shelford, right? Like whatever, right? Like retail stores on East Brainerd, right? Like that kind of localized. But when most people look at the data, they're like looking at MSAs. They'll be like office in Chicago, apartments, and that data is really easy to get, by the way, which is why the Class A stuff in the bigger MSAs is more sensitive to the market, and that's why we've seen. I was talking about this with Dave earlier, like. Multifamily real estate, Class A real estate across the country in big MSAs is already down 30%. It's already happened. The crash has occurred. And by the way, the housing crash has occurred too. Like it's already started. Who here sold a house 3 years ago? Cool. Somebody who wants to volunteer to be my guinea pig right now? I don't know what you're going to say. I don't know you, so let's go with you. I know you got a bite of food in your mouth. I'll let you finish chewing. It's fine. Sorry about that. So what's your name? Keith. Okay, Keith, you sold a house a couple years ago? Yeah. Tell us about the house. What'd you sell it for? Where's it at? How many bedrooms? That kind of stuff.
Red Rank area, I think it was a high school, 3 bedroom, 2 bath, 1,400 square feet. Sold it for about $265.
Okay. Everyone heard that? 265, three bed, 2 bath, Red Bank area near the high school, decent house. What do you guys think that house would sell for today?
Zillow has that 358 with Zillow.
Okay. All right, cool. So you think it went up in values in 3 years?
Yeah.
And it was 3 years ago? Okay. Who sold the house 2 years ago? Someone? 2 years? Okay. That's yeah. What did you sell 2 years ago?
With one bath for 175.
Okay. And where was that at?
160. Done that.
Done that. And what do you think that house would sell for today?
Just about the same.
Just about the same. Anyone else sell anything 2 years ago? Because you know what happened? Here's what happened, right? Like, and I've asked this question in groups all over the country, not just here in Chattanooga, but even my own house. Like, I sold a house in Hickson, my personal residence, sold in 48 hours, got above ask, and it was 2.5 years ago, right? 510,000, 3 bedroom, well, really 4 bedroom, 2,900 square feet. If I sold that same house today, it'd be about 500,000. It's basically the same price. If it was 4 years ago, it went way up, right? Like the market was going up and then it just kind of flatlined. Does everyone agree that price is basically the same as 2 years ago? So why do I say there's been a crash? If prices are the same. No, you know what it is? It's this like, how much did it cost to buy a gallon of milk 2 years ago? How much did it cost to buy an ounce of gold 2 years ago? Right? There's a ton of freaking inflation, right? Like prices have gone up 20 or 25%, and houses have stayed exactly the same. So if houses stay the same, and when prices go up 25%, what that really means is the dollar's worth less. It's not the prices went up, the dollar's worth less. It takes more dollars to buy the same stuff, unless you're buying a house. Now the interest rates actually offset this somewhat, so there's complicated analysis there, but the reality is my house in Hickson that I sold 2.5 years ago is worth 25% less today than it was 2.5 years ago because my dollars are worth less. I'd rather have $500,000 2.5 years ago than $500,000 today. It's just the reality. And I call that the shadow crash. No one's talking about it, but it's why I don't think we're going to see an enormous crash in the real estate market cycle. But anyway, I digress. I can tell you a lot about Fred Foldvary and what I think about his analysis, but the reality is it's worth keeping in mind that it's possible he'll be right again. We don't know what he would say today. I tried to find this a year or so ago and found out he died of COVID. So we'll never know what his analysis is. He wrote an article a month before he got sick where he said he thought that the real estate market cycle might be reset by the injection of capital and that it might extend for another 18 years. I don't see that as very likely, to be honest, but it is possible that he was looking at data that I don't have, and we don't know what he would say today. So anyway, why multifamily investing? In spite of all this negative market cycle news that I just told you about. And I'm going to talk to you about the reasons why I think that by sharing about, and I'm sorry, I don't have a clock. So is there a clock on here somewhere? I see it. Cool. Just want to make sure we're in a good time zone here. All right. So first of all, are you guys all familiar with different ways to value property? Has anyone heard of the comparable sales method? I hope so. So comparable sales is just like, I sold my house. My neighbor wants to know what his house is worth, and it's pretty similar to mine, so it's probably worth about the same as mine. Right? That's what appraisers use for single families, duplexes, triplexes, quads. It's a super common valuation method. You make some adjustments based on square footage and whether it has a garage or not, but ultimately it's adjustments to a comparable sales. You're looking for houses that are relatively similar, and you're saying if this one's worth that, this one's worth that. Super useful in the appraisal world. But there are other ways to do it. There's replacement costs. That's generally what your insurance company talks about. It's like, what would it cost to rebuild this? And I hear people a lot of times saying, well, this has got to be a good deal because I'm buying it below replacement cost. That's not necessarily true, right? It's worth whatever it's worth. Just because you can't afford to build it doesn't make it a good deal to buy, right? It's got to work. And that's where I think the capitalization rates come in. And we're going to spend a lot of time talking about that, but that's basically an income approach. And that is what appraisers use for commercial property. And commercial property is, all the things you think of as commercial: retail, office, industrial, storage units, but also every single residential property 5 units and up is considered commercial property. That's the distinction. You can't get the same kind of loans on them. They're appraised differently. They're valued differently. This is a critical distinction, and this is the main reason why I believe multifamily right now is your best possible investment. But you still do need to be careful because we're going against a pretty big headwind right now, right? Like the economy, inflation, uncertainty around the election. There's all sorts of stuff that we have to consider, but that doesn't mean that you can't control a lot of it. And that's why we'll talk about that. Anyone familiar with rent multiples, like gross rent multiplier? Does anyone use that in their calculations? I don't think it's a really good valuation method. It's really good, like rule of thumb to see if it works for you on paper. Like you want, like 1% rule stuff and like things like that. But those valuation methods aren't very useful. Discounted cash flow analysis is useful for businesses and stuff like that, but it's really not that useful inside of real estate. So who knows what a cap rate is? That's my number 3 on the list. Anyone know what it is? Anyone want to take an effort and try to explain the formula for calculating a cap rate? It's okay if you don't. You want to? All right, wait. You want to. What is it?
I know the formula.
What's the formula?
NOI divided by operating income divided by purchase price.
All right. So essentially, yeah, that's right. Net operating income divided by purchase price equals the cap rate. That's the classic cap rate formula. Now, anyone here take a high school algebra class? Everyone probably. Yeah, right. So here's the thing about algebra, right? This is a simple equation. It's only got 3 variables. And when you have a simple equation with 3 variables, you can calculate any one variable if you know the other 2. So we can mess around with this formula and we can say purchase price equals net operating income divided by cap rate, or net operating income equals purchase price times cap rate. Now, purchase price is a stand-in for valuation in this case, right? Because what we're really saying is, what's this thing worth, right? So if we know these 3 variations of this formula, we can determine what a property is worth. We can determine that's purchase price, like what should I pay for it? Well, if I know what the net operating income is, does everyone know what net operating income is? Do you understand that? Just to be super clear, the NOI, or net operating income, that is the totality of all of the rents and other income collected, less all of the ordinary expenses, excluding things like income tax and interest and amortization. So it's like if you bought this for cash and you paid $100,000 for it and you made $10,000 after all your expenses, maybe you collected $20,000 in rent, you paid property taxes, you paid insurance, you paid maintenance, and you had $10,000 left, it would be $100,000 is your purchase price, and your NOI is going to be, $10,000. So now in that scenario, can we calculate the cap rate? Well, we can. We've got the formula, right? So cap rate is net operating income, $10,000 divided by purchase price, $100,000. 10,000 divided by 100,000 is 0.1, which is also known as 10%. So that would be a 10 cap. That's the simple concept behind a capitalization rate. It's a way to value a property based on the amount of income that it receives at the current moment. What did you pay for it? What's the projected income for the annual net operating income? That's your cap rate. Now, cap rates are actually set by the market. Now, this is counterintuitive for some people because what I pay for it is actually not relevant. I might get a good deal. The average of all the transactions in the market, that's the market capitalization rate, right? So we take all of the transactions for single family houses in Chattanooga if we wanted to calculate cap rates. And we wouldn't do this on single family because we'd use a comparable sales approach. But let's say we're buying 10-unit apartment buildings in North Georgia. I do this a lot. And we're saying, this is what we project. These variables are a little fuzzy, right? Because when you go to buy a property, you don't know exactly what your NOI is, right? This is where an appraiser comes in and has to make adjustments and say, that's unreasonable. Your expenses are a little low. It's probably higher. But the idea is still that if you have these information, it's really valuable. Now, this is where the magic comes in. This is why buying multifamily real estate really makes sense. Okay, so if you know any of these variables, you can calculate the other one, right? Which one of these variables can you control? Yes, you can choose to pay it or not, right? But reality is you don't get complete control over that because the seller has a say and the buyer has a say. So you have to agree on a purchase price. So you don't have that much control over that. But there is a variable we have a lot more control over once we buy it, right? And that's the net operating income. If we figure out ways to reduce the cost of operating, maybe we get a better management contract. Maybe we replace some toilets so we have lower water bills. Whatever it might be, to lower the operating expenses, that's going to raise our NOI. The other thing we can do is we can make strategic improvements to raise rents. We can bring rents up to market. We can do things to make the property more attractive and cause rents to go up. So we again, we don't have full control over any of this, but we do have a lot more control over that particular variable. So if you buy a 10-unit building in Red Bank, let's say, and let's say you pay $700,000 for it, great deal in today's market, right? But it's really shitty, right? It's run down, it's ugly. It's got people paying $400 a month in rent in it when the rent should be $1,000, or whatever, right? Now that property is actually only worth that money because if the NOI is what the NOI is and the cap rate we don't control because that's an average of market transactions, we know that that property is worth what we paid for it. But what can we do then is we can do a value add strategy. I can go in and I can put hard surface floors in. I can go in and I put granite in. I can put new windows. I can paint the exterior. I can maybe stripe the parking lot, do some landscaping. I do all this stuff, and now instead of getting $400 a month in rent, I'm getting $1,000 a month in rent. Well, now instead of having an NOI that's $10,000 a year or something stupid like that, or $20,000 a year, my NOI might have gone up. My expenses all gone up a little bit. Of course, my cost basis is going to go up a little bit. But the reality is my NOI is going to go up a lot. So in our hypothetical example, the $10,000 NOI, $100,000 property, if I go make some improvements and I raise the NOI from $10,000 to $15,000 a year, what is that property worth? What would the market value it at? That's the question. Anyone want to take a guess? Remember, this is a 10% cap rate in that hypothetical. We're just trying to make the math super easy so y'all can do it in your head. So now the income went from $10,000 to $15,000. Property was $100,000. Yeah, go ahead.
So it's the same ratio. So the rent went up 50%.
Yes.
So the market price.
Yeah. It's not always the case. That does actually work that way when you're using a 10% cap rate because it's an inverse relationship. But that's right. The property will now sell for $150,000. It just will because it makes $15,000 a year. The market cap rate's $10,000. So new investor comes at it, looks at it, and goes, "Oh, I can buy this at market price. It's 10% cap rate. That's it makes $15,000 a year." And so when we're making these multifamily improvements, we're making this decision based on what is my return on that particular investment. And most people won't do it this way, but if you're really sophisticated, this is what you're going to do. I bought a 12-unit in Ringgold for $600,000. I owned it for 2.5 years and sold it for $1.3 million using this exact strategy. Think about that. $600,000 to $1.3 million. I put 20% down, so $120,000 down. I turned that into $800,000. I then 1031 that and bought a strip mall for $2 million, which is now worth like $3 million because I did the same thing there. I increased the net operating income, right? Now, so I know this works. I've done it over and over and over again. This is what I do every time. And you really need to wrap your head around this because it doesn't matter where you are in the market cycle. If you can wrap your head around this, you can find opportunity and you can make money. It's literally that simple. So if I'm looking at, should I put a slider in? This is a real question I had, right? I'm looking at my property and they were townhome style, right? 12-unit townhome style. And I'm thinking, I could cut off this back wall and put a slider in and put a little privacy fence up and they'd have a little private backyard for each unit. And I think to myself, like, that's going to cost me $1,800. It would be a little bit more now because of inflation, but it cost me what it costs, right? So it costs about $2,000, a little bit less, including labor. And I thought, okay, so does that add $2,000 in equity or more? That's the question, right? Well, how do I know the answer to that? Exactly, right? So you know what I did? I put a survey together. I came up with all these things that I could do. I could give you new windows. I could put in a slider. I could make you a privacy patio. I could split your laundry room because this had this weird situation where there was 2 units side by side and they shared a laundry room. I could split that. It's going to cost me $5,000 to do it because I put another, whole another set of plumbing in and figure out how to split the water. And it was a mess. But anyway, I have all these options, and I say, which one of these things would you want? I just surveyed all my tenants. Which one of these things would you want? I want to know what they're going to pay, and also. How much would you be willing to pay if I gave you new windows? How much would you? And I mean, I didn't word it like that, but I literally sent different surveys to each one too to see how they responded. We worded them differently because I was just really geeky on this. And we decided it made sense to split the laundry rooms for $5,000, and it did not make sense to do the patios, even though that was $2,000, because people said, I would gladly pay $75 a month more in rent for my own private laundry room. That blew my mind, but whatever. That's what people were willing to pay. So now, what does it cost me in extra like operating cost to have that separate laundry room? Not very much. It costs me, there's the $5,000 capital injection, right? That happens, but that's for 2 units, so it's really $2,500 a unit, and I'm gonna get $7,500 a month in rent more, and I have a little bit of management costs and stuff. Well, that's 75 times 12 minus the management cost, a little bit of miscellaneous. Let's call it brings in $7,500 a year, right? So is that a good return or not? Is it? I mean, if you invest 5,000 and get 7,500 a year in income, is that a good return? What do you guys think? The answer is of course. So it's not that much though, right? Like I did the math wrong in my head right now. It's like 750, but who cares? Still a good return. You invest 5,000 and you get 1,500 actually, because you get 75 times 2, right? So you get 1,500 on 5,000. 1,500 divided by 5,000 is like 30%, somewhere around there, a little bit less. So it's a 30% return. Well, all I need to know if that's a good investment or not is that 30% higher than the market cap rate? And the answer is absolutely yes, definitely, right? Whether it's 10% or 6% or 5%, it doesn't really matter. But that market cap rate was definitely lower than that. So that meant as soon as I spent that $5,000, I was raising my NOI by $1,500 a year. That $1,500 a year at a 10 cap is worth $15,000, right? 1,500 divided by 10%. That's one of the formulas. So 1,500 divided by 10%, it's 15,000 in equity. I spend 5, I get 15,000 in equity, and I made every single decision for all of my multifamily based on that. No, I mean there are some things that are different, right? Like you have to fix certain things. You have to make sure you provide a safe and secure environment and all that. But at the end of the day, if it's a variable that you're not sure about, you get to control the NOI and you get to control the equity gain you get. And that, to be honest with you, if we just stop talking right there, that is the only thing you need to understand about multifamily investing. So does anyone have any questions about cap rates, how they work? Does it all make sense? Everyone's following?
Do you include capitalized?
Okay, so capitalized expenses only really matter for tax purposes. Technically they're pulled out of your NOI. So if I spend $100,000 putting a new roof on, it's my NOI is not negative 100,000 for that day. My NOI is going to be what's the lifetime of that roof spread out over time. Most people make the adjustment in the form of a CapEx reserve rather than try to calculate it on an individual basis. So it might be like $25 per unit per month is my CapEx reserve. That comes out of your net operating income because that's a real expense because it will occur at some point in the future. It's a technical adjustment to NOI, but it really doesn't matter that much in the scheme of things as long as you wrap your head around the fact that your net operating expenses are what your costs are going forward, not like what did I spend yesterday. Now they usually calculate that based on like a T12 or like a 90-day version of a T12, like a T3, but it really doesn't. It doesn't change the numbers that much, but you do need to wrap your head around that. So that's a good point. Did that answer it enough for you? Okay, cool. All right, so we shall move on from cap rates. So I promised to talk about risk mitigation. Let's see what time we got here. Okay, we got a couple more minutes yet, so let's get. All right, so I think there's a couple of key concepts here: risk-free rate of return and risk premium. Does anyone know what a risk-free rate of return is? Yeah, exactly, right? So it's like, what would you get if you took no risk, right? So if you invest in a government bond, 10-year government, I think is it 30 years? I think they use the 30-year for risk free, but it doesn't really matter.
Short end.
Yeah. So anyway, so the risk free rate of return is just whatever the market says it is, and then the risk premium is the rest. So this formula right here, the risk free rate of return plus the risk premium equals your market rate of return. This is another way of looking at the cap rate, right? So cap rates are comprised of this risk-free rate of return plus the market risk premium equals the cap rate as well. So if you're in a 10 cap market like our hypothetical, and we're not, by the way, in case anyone's trying to price multifamily, we're probably in like a 6.75 for Class B, maybe a little less for Class A, maybe a little higher for Class C in this area. It might be 7 now. It's trending up because of the risk-free rate of return, not anything else. This is actually why the 30% reductions occurred in multifamily. The risk-free rate of return is based on the Fed borrowing rate, as Brandon said, and that's gone up a lot because interest rates have gone up. So our risk-free rate of return has gone up, which means that if you only have two variables and you raise one of them, the market rate of return's got to go up to account for that. And if you go back to our formula on cap rate, you recognize that higher cap rates, because they're on the bottom side of that fraction, mean that values are going down, not up, right? So if you people say, "Oh, 10 cap, it's a great deal," maybe, right? But what that really means is it's more risky because there's only two variables and everyone has the same risk-free rate of return. So if there's a market where they're paying a 10 cap, you're getting paid a pretty big risk premium. The difference between let's call it 5% is about what the risk-free rate of return is right now. Maybe a little bit less, but somewhere in that range. It changes, daily. And so it's a 10 cap market. It's 5% risk-free rate of return, 5% risk premium. If we're in a 7 cap market here, it's 5% risk-free rate of return. It's a 2% risk premium. So that means this market versus that imaginary market is, 2.5 times safer. That's really what it means. That's why California trades at a 5 cap now. It was a 3.5 cap, right? There's a very little perceived risk in California, so it trades at just a tiny bit above the risk-free rate of return. But that does mean when the risk-free rate of return goes, they have a very, very sensitive to the market. If the risk-free rate of return is 2% and it goes to 5%, and California's goes from 3.5 to 6% because of that, they lost half their value almost, right? Because it's an inverse relationship. And that's what we saw, right? The risk-free rate of return went up. So cap rates are forced up in the high-end markets that have really low cap rates because they can't have a cap rate below the risk-free rate of return. Stuff that was 3.5% had to go to at least 5 because it's a formula. Even if you say there's no risk, there's still have to pay for the risk-free rate of return because people wouldn't take the risk of investing at 5% if they can get 5% with no risk. You need to be paid for the risk. That's really what it is. This is basic economic theory. It comes right out of a finance textbook. But it's really important to understand when you're talking about risk mitigation because you can't mitigate the risk-free rate of return. There's no way to mitigate that, right? But we can mitigate our own personal risk. So let's just assume Chattanooga is a 7% cap rate. If I'm buying a piece of property in Chattanooga, and I'm from Azerbaijan, and I've never bought a multifamily property before. How do you think I'm going to do investing in Chattanooga? I've never done it. Taking my only stack of money, and I'm going to go buy a property, and I'm going to try to buy it.
You should comment the stuff on the mountain.
What's that?
You should comment the stuff on the mountain.
Yeah.
That way you really pay the most.
Yeah. That's my thing, right? People don't know, right? You don't know what you don't know. So they're taking the market risk premium and they're going to get that deal based on market risk premium, but it's an average, right? Some properties are better than others. Some are worth more than others. Some properties are going to trade at a 6.5 cap. Some are going to trade at an 8 cap. That's just the way it's going to be. And if you don't have that information, you can make a mistake. So that's okay for people that have the information, but that's, to me, the number one way that we mitigate personal risk in real estate is by getting market knowledge. We have to have really deep market knowledge. So if you're looking at investing in multifamily, and you're thinking you want to do it, don't immediately go, well, people in California are doing this all the time here, right? They're like, oh, California sucks, so I'm going to buy in Chattanooga. It's driving down our risk premiums because, the more people pay, the lower the risk premium. But it's good for us in a way if you already bought real estate, but it isn't good for them because they're going to make mistakes that we're not going to make because we're here. And if you're going to do that sort of thing, invest in a different market, you better figure out why. So you might say to Jeff, why do you invest in Detroit? Why do you do that? You live in Chattanooga. Well, I'm from Michigan. It's not that complicated. I don't pick real estate in random places. I pick it in places I understand. I've been going to Puerto Rico for 2 weeks a month, almost every month, for the last 3 years. I still haven't bought a piece of real estate in Puerto Rico. And Puerto Rico is like Detroit in 2013. They're a completely different place in the market cycle. If y'all want to make a ton of money, go get really good at Puerto Rico. I mean that. You can make stacks of cash. Stuff's trading. I saw a property trade hands a year ago, it was traded at a 15 cap rate, and it was a 40-year, just renewed government lease to a post office. And it traded at a 15 cap rate. The United States government was the tenant, right? And it traded at a 15 cap. That's absurd. Who would buy that? With my limited knowledge of real estate in Puerto Rico, I believe I can make that one work. But I've been going there and building knowledge about Puerto Rico on purpose because I know it's like what Detroit was for me in 2012, 2013. I am 100% convinced that my next big wave in future wealth is going to come out of Puerto Rico. But that doesn't have to be true for y'all. Y'all live in Chattanooga. You're here now. Like, keep studying this market. So that's how you're going to mitigate risk. And the secret to risk mitigation is to have more knowledge about the market, also to have more knowledge about the assets, right? So you know what I buy is I buy 10 to 40 unit buildings in this market. I don't buy 100 unit buildings. I mean, I'm working on learning that area. I don't buy a lot of single family houses. Nothing wrong with those. I buy things that I know. I understand what my tenant base is going to look like. I mean, another example of this is like, I understand how those things are going to work, what they're going to be like, what kind of problems I'm going to have. I'm buying the same, relatively the same age buildings, right? Relatively the same class of building. Because if I buy a 200-year-old building or a 150-year-old building, I bought one that's 107 years old in Port Oglethorpe on the Barnhart Circle. There's stuff that comes up that I didn't know was going to come up. It makes it more complicated, right? Like I took more risk by buying a building outside of my regular buy box. And then the other thing is the fundamentals. Just get really good at cash flow, cap rates, long-term debt, all that stuff. Just learn a lot about real estate. But this is how you're going to mitigate risk. Oops, I went the wrong way. Oh well. Look at that. I can sort of go back. All right, well, whatever. Let me finish up mitigating risk, and then I'll tell you about the passivity scale real quick, which is like kind of a bonus topic for us. So the thing is, if you can figure out a way to mitigate your personal risk relative to the market, you're going to get compensated for market risk while taking less risk on your own. This is what hedge funds do in the stock market. It's what sophisticated real estate professionals do all over the world. If you can take less risk than the market, you're going to come out ahead overall in the long run. It's like the house always wins in blackjack. Even if you're really good at blackjack, you're probably not going to win in the long run because they shuffle too often for you to count cards. It's the same thing with all games and casinos, but it's the same thing in the market, right? Like if we can beat the market by just a little bit, over time we win. We get extraordinary returns and we become rich. So who wants to become rich? Everyone? Someone doesn't? Who doesn't want to be rich? Anyone? I mean, it's cool if you don't. I'm just curious. All right. So I'm talking about the passivity scale. I skipped like 6 slides ahead. I don't know how to go back, so we're not going to worry about it. The general idea is passive real estate investing does not exist. That's the idea. Like anyone who tells you differently is lying. This is, I said I retired. When I didn't retire, I'm still here talking to you about real estate. I'm still buying real estate. I'm still managing real estate, right? But even if I hired property managers, even if I went full turnkey investing or invested in REITs, I'm still doing a little bit of work because I got to find the property. I gotta vet the managers. I got to decide what REIT I want to invest in. This is the low, not very much work. This is a lot of work. And there's even further, right? Like if you build your own property, right? Or you take a rundown roadside inn and turn it into the groovy nomad. That's a lot of freaking work. No, you get compensated for that work, right? But it is a lot of work. So you've got this whole line of passivity, and you've got to decide where do you want to fall on this chart, and you've got to decide how much of it each section do you want to do? Because the reality is, you can have some self-managed properties, and I have a couple, 4 units, duplexes I deal with, and one retail shopping center. You can have some professionally managed. I have a bunch of that. I don't have any turnkey. I do have some REITs, and I have done this last one, investing with people you trust. That's like syndication, right? Like you could call me up and say, "Hey, Jeff, I want to invest with you. I'm going to give you $100,000, and I want you to put my money in your deal, right?" Well, I don't have any apartment buildings for you to invest in right now, so I'm not pitching you on that stuff, right? I will tell you, I do have one possible thing you can invest in if you want, and that is this amazing deal in Puerto Rico. Happy to talk to you about that. I'm not going to spend a lot of time on that, but Puerto Rico is where it's at, and the very short version of Mueller catamarans is we're going to build sailboats in Puerto Rico for the U.S. charter market. We're in the middle of a raise on that right now, so we can talk about that. But the really, really super short version is there's a lot of tax incentives that you may have heard of in Puerto Rico. So we're going to be able to outcompete other manufacturers, and we will be, as of right now, the only US based manufacturer of sailing catamarans designed for the charter market. And that's very significant because there's this law called the Jones Act that says any commercial sailboat, any commercial sailing vessel, actually, so even non sailing vessels, have to be manufactured in US waters. Our boats are going to come out of the port. We have the land location, everything in the port of Ponce with a Coast Guard certificate of inspection, so people will be able to immediately put them into service. Where right now, if you want to start a charter sailing thing to take people on sunset sails in Key West, you literally cannot buy the boat. You have to have it custom made. It takes 4 or 5 years. It costs $4.5 million. Our boats will be $2 million, and they'll come out in 90 days. So we'll have this enormous competitive advantage, and I really believe this is something that y'all should probably all invest in today. Oh, you do have to be an accredited investor, by the way. So we do have that. Oh, if you don't know what that is, that's basically it's a net worth or income requirement. You have to have $1 million net worth, not including your primary residence, or make at least $200,000 a year individually, or $300,000 with a spouse. So if you want to talk about that, I'm super available. Facebook, Instagram, all that. I'm happy to chat with you. But that's what I'm doing in Puerto Rico. Here's some fun stuff I did lately. I went to Antarctica, I went to Bali, the rice things, I went to the Great Wall of China, I climbed Kilimanjaro, I went to Australia. It was fun. This is why you should be investing in real estate, right? And anyway, that's it. That's all I got. So with that, does anyone have any questions about any topic on anything in the entire world? I'm feeling very ambitious right now. Okay.
So when you're doing your value add calculation, when your ROI exceeds the market cap, right? That's what your basis of making a decision is.
Yeah, exactly. I'm looking at what does it cost me? What am I going to get as an increase in net operating income? It doesn't make sense based on the cap rate. Yeah.
Is there any particular rule or like rule of thumb you go by? Like we're trading at 7. Are you only looking at deals that are like 3 to 5 points ahead of that, or is
No, I'm fine with buying stuff that trades right at the market. Actually, most people think you have to beat the market, not buy. Everyone always says it's not like it's when you buy that you make your money, but that's not really true. It's the managing of it, raising the NOI, that's where you make your money. So you have to buy stuff that has upside potential, right? So you got to look at it from a different set of eyes. You can even pay like above market price if you have a clear path to raising net operating income. And we've done that. We bought in East Ranger. We bought when cap rates here were about 7%. We bought a property at a 5.5%. It was I think 21 unit apartment building on East Ranger Road. And people are like, why would you buy this? It doesn't make sense. It doesn't work. Well, we weren't buying it to raise the rents and stuff. It was a relatively new thing. We were going to chop it up and make it into condos, right? So we're doing something completely different. It doesn't matter. We paid $120,000 a unit. We sold the condos for $265,000 a unit, and it did not cost $140,000 a unit to turn them into condos. It was $20,000 a unit to do that. So it was a huge upside play. So you don't really need to worry about what the deal looks like on the front side. You got to look at what am I going to turn this into? Am I going to convert it to something else? Am I going to raise the rents? Am I going to make it from a B class to an A class or a C class to a B class? It's really hard to do B to A. C to B is possible if you're in a good market because you can fix the building up. If you don't know all those different classes, it's really just like A is the brand new stuff. C, the B stuff is like kind of good, kind of older, 10, 15 years. And then the C is even older yet, in worse shape. And then D is like war zone you don't want. So that's pretty shit. All right, who else has got a question? Go ahead.
Can you talk about some of the tax advantages of buying multifamily and how that might change over the next couple of years with cost segs and bonus depreciation?
Sure. Yeah. So I love cost segs and bonus depreciation. I think it's amazing. The super short version is, you all know that like when you buy a piece of property, you have to separate out the value of the land from the value of the property when you do your depreciation, right? That's what a cost segregation is actually. That's like the basic level cost segregation. But you can hire an engineer to come in and decide how much value you have in cabinets and fixtures and landscaping. and you can assign it to different categories. Land is not depreciable, so you have to take that out. That's required by the IRS. But the IRS also allows, and in fact encourages you to say, hey, I bought this property for 100,000, 20,000 is land, 80,000 is everything else. But that 80,000, 20,000 of it is landscaping and driveways, and that stuff depreciates over 15 years instead of 27 and a half years. So you're accelerating your depreciation schedule, and depreciation is a non-cash loss. It's not real, so it means you save on taxes, but you don't actually lose money. So it's amazing. But there is some real reality to it because you will have to fix your landscaping at some point. You will have to fix your driveways at some point. So the IRS is just acknowledging that things get worse over time, and they're letting you write it off over that shorter period because the building is going to last longer than the driveway. The cabinets are going to last less longer than the driveway. They're going to be 5 or 10 years. And so they have them in a 5-year category. And there's these different categories, right? I think it's 3, 5, 7, and 15. I don't really know. I don't pay attention. I let the CPAs deal with that. But in 2017, when the Trump tax code passed, they came up with a thing called accelerated depreciation and bonus depreciation, where they said anything that was 15-year property or less could be taken 100% in the year you purchased it, which meant that when we did these cost segregations in 2018, 2019, 2020, we were getting somewhere around 25 to 30% of our purchase price as a first year write-off, which is amazing because if you bought a property for $1 million, put $200,000 down on it, you got a $300,000 imaginary loss, and it wiped out all of your taxes for the year. So I haven't paid taxes since 2017 because of bonus depreciation, like $0 in federal taxes. That's why I don't live in Puerto Rico. If I move to Puerto Rico, they don't recognize bonus depreciation, and I'll pay a bunch of tax. I don't pay any now, right? I would love to live in Puerto Rico. The place is amazing. I have an apartment there. I'm there almost half the time, just a little hair fuzz under, so I don't have to worry about it, right? But the thing is, because of the way the government works with budgetary constraints, they have this requirement that you have to show that there's a net revenue neutral over a certain period of time in order to pass these kinds of tax things, because it was part of an omnibus budget thing. And so the way it was passed, they had to phase it out over a 10-year period. So 2017 to 2027, we have some form of bonus depreciation. But starting last year, they lowered it from 100% to 80%. So this year, it's 80% of your 15-year or less property can be written off. That doesn't mean you lose the other 20%. It just gets spread out over a longer period of time. Next year, it goes to 60%. The year after, 40, then 20, then it's gone. Now, that may change, right? I mean, Trump may get back into office and pass another tax code, and then we're back to where we were before. But we can't base it on that. Like, we have to go with what the law says now. Like, we can make all kinds of speculations about the future, but we really don't know. We just have no way to know. But that's why I think multifamily's tax advantages are declining right now. But that doesn't make them not worthwhile because you still get the same depreciation over the lifetime of the property. You just don't get it as fast. And obviously, getting to keep your money in your pocket now allows you to accelerate your growth. So it's better for real estate investors if they extend that.
How do you mitigate the higher expense related to the recapture?
Well, I mean, you can do 1031s, it's one thing, or just never sell. I mean, I don't sell a lot of stuff, so I don't really worry about recapture. But the reality is, you're probably not going to pay a significantly higher rate on recapture because your income is going to go up dramatically. And one thing you can do if you don't want a 1031 is just buy something else. So, like what we've done for the last several years is whenever we've sold something, we bought something else with the money and then got an excessively large tax deduction that offset all the gains on the other property, which of course, as it fades out, is going to cause a tax problem for us into the future. And I fully recognize that. And you could move to Puerto Rico to mitigate that. So it might be a thing. Yeah.
So most of your relationships after bankruptcy, it was kind of 5Xing, 10Xing in Detroit. Was there much else? Is it because the properties?
Yeah. So I glazed over that a bit because I've actually given a talk just about my life story in Chattanooga a few times. I didn't want to bore people with the same stuff, but I didn't have any money. I didn't have any credit. And I knew that market. So I was like, geez, if I can buy my first property was a $30,000 condo. I split with a friend. We paid cash for it because I didn't have any credit. And I had saved up $20,000 from my job after I moved here. And it rented for $750 a month, and we just kind of went like, oh, we can buy it for 30,000 and rents for 750. Great. So we just bought it. We still own it today. It's worth about 200,000, right? So it was a good investment. But I started buying in Detroit because it was more affordable. And because I had a friend there that owned a property management company, and I partnered with him on every single deal I did in Detroit. I still do. So I have 50-50 partners on most of that stuff. Um, and yeah, and so we just started doing it. And then we started flipping houses, and we'd flip three, take the proceeds from the three flips to buy one in a slightly better neighborhood for cash. So we'd be flipping houses that we were paying 10,000, 15,000 for, put 5, 10,000 in them, selling for 40 to mostly to foreign investors out of Japan at the time. There's a lot of Japanese money coming in Detroit then, selling for 40, 45,000 at an 8 cap because they just wanted to stabilize their currency. And then I wish we kept a lot of those because those houses are all worth 150, 200 now. But we used the money that we made on those 10,000, 15,000 per flip to buy a $40,000 house in a slightly better neighborhood and keep it. And we just did that on repeat because I didn't have any money and I didn't have any ability to finance. I mean, I literally had a negative net worth. I went to law school, I had $100,000 in student loans, didn't go away in bankruptcy. And I had, my credit had just gotten hit by a nuclear bomb because that's what bankruptcy does to your credit. So I had no choice. It took 6 years before I could get a conventional loan. I didn't even have credit cards. Like I didn't have choice. Like I had to do that.
What was your first multifamily? Like, was there a big jump from doing single family to multifamily?
Yeah, so it was after I quit my corporate job in 2016, and I had that period of time when I was bored, and I did a burr on a duplex in off of 58, and I had some money from that. And one of my bankers said to me, you really should think about doing B class multifamily. Yeah, maybe. And then I read that book I told you about by Brian Murray, and I thought this stuff makes a lot of sense. So I started looking, and I bought something right off of LoopNet in Ringgold. Um, I overpaid a little, but it didn't matter because, like I said, it's the first one it's only really one of the only ones I've ever sold. Bought it for 635,000, sold it for 1.3 million. So
How many units?
it's 12 units. Yeah. No, the market helped me on that. I mean, between 2017 and 2020, when I sold it, the market was up a little bit. I sold it like right before COVID, so like early 2020.
Would you say that one changed your life? Like, that was the first big one?
Yeah, well, that's the first one I exited. I don't know that it changed my life because as soon as I bought that one, so this is what happened. I bought that one September of 2017. The Trump tax code passed the first week of October. They retroacted it to the day before I bought mine. So I got a huge bonus depreciation, $120,000 write off. And I went, holy crap, that's great. Cause I just gotten like my quit my job bonus like thing, they like severance package. So, and I converted myself to a real estate professional. So I was able to take active um, income and apply it against real estate losses, which you can only do if you're a full-time real estate professional. I mean, I'm not giving CPA level advice here, so like, deal with your CPAs. Um, but it did, yeah. I mean, I didn't have any. I made my tax bill go away. I thought I was going to pay 30,000 in tax, and I paid zero. And then we immediately had a cash flowing asset that we were able to redeploy the money. But I mean, it only takes like one or two of those, right? Like if you did one or two of those, your life is completely different. But we bought. My partner in Detroit got a little jealous when I told him I was buying this one in Chattanooga, and he's like, "Why aren't we buying apartments?" I'm like, "I've been telling you for 6 months we should buy apartments." So while I had that under contract, we put a 19 unit under contract in Detroit. So I bought that. We still own that one. Bought that for I think it was like just under $1 million, and it just appraised for 2.5. That's insane, right? Like it's been 5 years, but that's ridiculous. We put $200,000 down on it, and we have $2 million in equity. Yeah.
Yeah. So, I know you said earlier that now would be the worst time to build multifamily, especially if you have possession exiting at a certain cap, depending on what the market does. What about built to rent?
Yeah, same problem. Like rents are falling, occupancy is starting to fall. I think everyone's jumping on that bandwagon because nothing else makes sense right now, and I think that's a giant mistake. I've always been a go against the flow. When I was buying in Detroit, people were on the podcasts and saying Detroit's dead. Never invest there. It's dead forever. You should never buy anything. Now everyone wants to buy in Detroit, and I'm like, time to sell. Like we need to do what the market's not doing if we want to make money. I mean, obviously, don't just ignore the market completely, but if everyone's on the bandwagon, then it's probably too late.
Well, just to touch on your points, it's interesting you've been talking about market cycles. I actually had a conversation with a buddy that's moved up to Nashville, moved into a Class A, brand new build. They're offering 2 months free, and the concessions they were offering.
Listen, yesterday I was at a group real estate meetup that I go to here locally, and one of the people there is a big developer, and he told me that they're offering 3 months of concessions here on new properties. And not in his, but his competition's doing that, and that's driving down his rents. What's that?
One market.
Here, Chattanooga, yeah, in Chattanooga, 3 month concessions on rent, and that's just because they need to like hit their projected rent numbers. But the reality is, he told us also that he's got properties that he rented brand new last year for 2,200, and now he's releasing to the same tenant for 2,000. He's lowering their rents to get them to stay because their alternative is they can go move down the street to a brand new unit and get 3 months free. That's a problem. And that's what's going to continue to happen for the next couple of years. It just is. Like we're not going to. I don't think we're going to see a gigantic crash. I don't think that's coming. But I wouldn't want to fight against that trend. I would start looking at like the stuff that's further down the trend. And I think, if you can do value add stuff, you can always make money because it's enough to fight against the trend. But I mean, realistically, you probably all just come to Puerto Rico and invest with me there. Like, I mean, like Mahoro.com. just sign up now. And like you get the information. But no, I do like for real though, like it's a hard time to be in multifamily, but that doesn't mean multifamily is bad, right? Like if you make it now, if you find deals now that work, they're gonna work even better later. That's my strategy on all real estate. Like if you can get like it's really easy to time the market cycle. Like probably should have put a slide up on this, but like buy whenever you buy, sell when it's high, right? That's how you time the market. But we don't know for sure when the prices are going to go down, but we do know when something's worth more than we paid. So buy whatever. If it works when you buy, if you have long-term debt in place so you don't have to refinance or sell during a recession, and you have adequate cash flow and adequate cash reserves, you literally cannot lose on real estate because it will go up with the rate of inflation. There are studies, I have a chart that I use sometimes that shows that real estate prices have gone up at the rate of inflation, not more, not less, on average for 200 years in America. So do we think that chart's going to change? The reason they aren't going up with the rate of inflation right now, like the last 2 years, is they went up